and welcome to this week's episode of Retire Right with Epstein White. As always, I'm Brad White.
And I'm Dave Epstein.
And you know, Dave, the summer's already creeping up to an end here. Any fun plans for the weekend? Anything else we're going to fit in here before the summer's already over?
No plans. The wife is moving the daughter to her sorority.
Okay.
Up here at San Diego State. We're excited for her, and my wife and I are excited to have the house back to ourselves. So.
Man.
Looking forward to that.
Summer vacation for college, right? Where is the summer vacation for financial advisors and financial planners, Dave? You know, that's always been something that's just escaped me ever since we left college.
I don't know what a vacation is like, Bradley.
Well, you know what? Your daughter's earned it. She is a fantastic student. Good for her. And unfortunate is she's got to head back now, right?
Yeah,
and get
she
the work
does.
started.
Yeah.
Just like our work has to get started right now, because as always, we have a tremendous show lined up for you today. We have our weekly retirement alert. And Dave is going to teach you how to build your own personal pension for retirement. So certainly a great alert that we have for you today. And we also have a fantastic viewer question this particular week. If you watch previous shows, you know that we always encourage you to reach out and give us whatever questions on your mind. And we're going to pick one each week and answer it. This week, we have a viewer that wanted to know what a Roth conversion is. And maybe even more importantly, is it a good idea?
Absolutely, Bradley. And financial tip of the week, understanding your risk tolerances, understanding your beta, and how that can help or hurt you in retirement. And lastly, Bradley, understanding ETFs, mutual funds, indexes, separately managed accounts, SMAs, so many choices out there to choose from, and which are the right fits for you in your retirement plan. Well, let's get this show started.
So what is the difference between a mutual fund, an index fund, an ETF, and even these things called separately managed accounts? Right, on this segment of Investing Smart, we want to arm you with the information always as far as what you actually own. And Dave, as it turns out, mutual funds are by far the most common tool that Americans have with not only their investments in things like their 401ks, but even other non-retirement accounts they have.
Absolutely, Brad.
So you've heard of mutual funds before, but there's some pieces of information that most everybody just really doesn't have an idea that exist inside these mutual funds. This information, if you're not aware of it, like a lot of things, could be harmful to your investment returns. So without further ado, let's talk about this mutual fund. A quick history lesson here is that mutual funds, kind of the modern day mutual fund, was created back in 1924 and went public in 1928 here in this country. Now, we've talked a lot on this show in general about this word diversification, right? We talk about it on our radio show, and really, Dave, to anybody that comes through our doors. And I'm sure you know that you don't want to put all of your money in just one stock, right? You never want to just put all your eggs in one basket. That's risky. So back in 1924, people didn't have a whole lot of money to just go buy hundreds of stocks.
$5 a month was the average savings to a family, and a share of GE stock was $16, Brad.
Speaking of a history lesson, right, there's an interesting thing to go back and realize. $5 a month is what the average American could save. So how could they get diversification? Let's all pool our money up together, right? Let's mutually own this one fund, and this one fund may have 100 stocks inside of it. So now the $5 that I have to save can buy this one thing. I get instant diversification. That's a great thing. And if I don't know how to pick and choose 100 stocks, then it's probably a good idea that the mutual fund manager is picking them for me. So no arguments here, right? And this was the most common tool for decades and decades. But one of the problems with mutual funds that's always been there is just the underlying fees that may occur, right? So every time, Dave, a stock or a bond is bought or sold, that's a trading fee that you pay. I want you to take a look up on this image we have behind us right here, which is an actual example of one of our clients' mutual funds portfolios they sent us. You'll see that column we just highlighted called turnover ratio. That tells us for all the stocks and bonds that are bought and sold what the fees are there. And a little bit to the right, we're now highlighting this column called expense ratio. That's an annual percentage management fee. You add up both of those and you get a total fee per year, which, as you can see again on the screen, is a pretty hefty fee per year. So hence the invention of an index fund, Dave.
Absolutely.
All right, Jack Bogle, or John Bogle, he kind of goes by both, believe it or not. Back in the 70s, his mission was to lower fees drastically and just have you as the investor follow this passive index. His belief was that if you lowered the fees, an investor would do better than paying some stock picker inside a mutual fund manager. So if you're just wondering right out of the gate, what is an index fund and what is a mutual fund? The biggest difference is that you're lowering the fees drastically on the index fund, and you're not hiring someone to try to pick and choose better stocks. You're just kind of passively following an index here. So I think that hopefully helps. And then, again, the technology helps all industries, right? And then along comes 1993, the ETF, Dave.
ETF is a powerful tool, folks. One that we love a great deal, very low cost, trades like a stock, Bradley. And, we love that because, when irrational behavior occurs, people making mistakes, emotional mistakes, of which we're going to talk about, finding your right beta so we can understand the risk that we're willing to take in retirement. Okay, when irrational behavior comes, when you own a mutual fund, Bradley, that can actually hurt you. Your powder could be dry, you could be cool, calm, and you're not going to let the markets, sway you from making a bad decision. But other people's decision can cause actually poorer returns in your mutual fund, actually could cause you paying taxes.
And so here's really what Dave's referring to when he says that. Mutual funds don't actually buy or sell. If you want to, quote unquote, sell your mutual fund, it goes back to the mutual fund company, which causes the mutual fund manager to have to buy and sell the stocks or bonds, raise the cash to give it back to the investor. And this only happens at the end of every day. So mutual funds can't be bought and sold in the middle of the day. And what you heard Dave talk about, which is a mutual fund manager may not want to buy or sell stocks at the right or wrong time, but if a whole lot of people are trying to sell or buy the mutual funds, it causes them to have to do that. That can cause you to have your investment returns be affected by other people. And in non-retirement accounts, believe it or not, that phenomena of the structure of a mutual fund could mean you actually pay other people's taxes. Again, that's only in non-retirement accounts, but you could be paying other people's taxes because of the structure of the way the fund works. So hence in the early 90s, this ETF, exchange-traded fund, was very similar to an index fund. Very much lower the cost, passively invest in some sort of index, except it buys and sells like a stock from one human being to the other. It doesn't go back to the mutual fund company. That means you can be more tax efficient usually with something like an ETF. Again, the fees tend to be very low. And it also means that you kind of avoid this irrational buying or selling that maybe a whole lot of other people are doing, Dave. So I know that that's something that we get questions on all the time. Which is a mutual fund best? Is an index fund best? Is an ETF? There's no universal answer. Sometimes a fund might be better than a comparable ETF. Sometimes an ETF might be better than a comparable fund. And that's why this can be so challenging. If you're looking for this kind of help and you need to make sure that you're getting your portfolio done correctly, that you're choosing the right tools, well then give our office a call, come to our website. We're happy to help review your current portfolio, your mutual funds, and help make some recommendations for you.
You made it. Years of hard work, investing, planning, and now you're here. The long-awaited reward you spent a lifetime looking forward to. But what now? After years of growing a nest egg, now you want to manage it. Use it to fund your dreams. Make sure it lasts as long as you need it. And make sure it leaves a legacy for those you love. So what do? Wall Street continues to be uncertain, and many conservative options have all but dropped through the floor. How do you maintain opportunities for growth without risking what you can't afford to lose? That's where we come in. We are financial professionals. From investments and insurance products to tax reduction strategies, estate planning solutions, and guaranteed retirement income you cannot outlive. You've worked a lifetime to get here. Let us help you enjoy it to the fullest. For a special free guide entitled 10 Things to Know About Retirement Income, simply contact us today.
Hi there, and welcome back to Retire Right with Epstein and White, and time for maybe my favorite segment of the week, which is answering one of your viewer questions, which we pick each week. And today we got a fantastic question from one of our viewers, which is, what is a Roth conversion? And maybe more importantly, is it a good idea to do a Roth conversion, Dave?
Oh, absolutely, Brad.
Something I think that people have been hearing more and more about over these last several years, and really even more over these last few years. So in order to understand what a Roth conversion is in general, let's kind of talk a little bit about making sure you're aware of a 401k and an IRA, which kind of leads into what a Roth IRA is. You know, it's interesting the way the financial world works, making things maybe sound more complicated than it is, right? A 401k is just section 401k of the tax code that was really created as a company-sponsored retirement plan, which means every dollar that you put into the 401k, Dave, right, you get that tax deduction. It lowers your taxable income. So that was a great kind of tax-preferred way for Americans to save for retirement. When you hear this word IRA, it just stands for individual retirement account. Same exact tax rules, but just something you individually own. It wasn't until the Taxpayer Relief Act of 1997 where Senator William Roth, who kind of spearheaded this, created this other form of an IRA called this, right?
Roth IRA.
Intuitively speaking, right? Roth IRA. The point here is that you don't get the tax deduction when you put the money in. But now all of the money gets to grow and all of the money gets to come out 100% tax-free as long as you've owned it for at least 5 years and you're beyond the age 59 and a half when you pull these monies out. Right, so unlike a traditional IRA and 401k, of course, where you're basically sitting on a bunch of money that's not all yours, right, Dave?
Yeah, absolutely. You have a partner in that money, folks, and it's not your spouse or your family. That would be Uncle Sam.
Yeah, not my favorite partner to have, right, certainly speaking. But, and it's kind of interesting that you even say that because oftentimes we'll see someone and, hey, how much is your 401k? What's the size of your IRA? And maybe that answer is $500,000. And then we'll say, no, you don't. You don't have $500,000. As a matter of fact, you might have really 3/4 of that or 2/3 of that, but you didn't really save up $500,000 because that partner
is Uncle Sam. He's going to want his piece.
So with this whole concept of a Roth IRA, you're pretty limited as far as how you can save into it in the first place. Right. When this was created back in 1997, you could only put $2,000 a year at most into it. And that was if you didn't make enough money, because if you made enough money above these income limits, I should say, you weren't allowed to have a Roth IRA at all. And today it's not that much better. You can only save up to $6,500 a year if you're over the age 50. And again, those same income limitations can still apply. Now, there are some Roth 401ks out there that are a little friendlier. You can save as much as $24,000 a year, and they don't have the income limitations. But by and large, generationally, for those of you heading into retirement and getting a little closer, the bulk of your money was already in traditional IRAs and 401ks. So this Roth conversion is where you take those existing IRA 401k dollars and you turn them into, or you convert them into Roth IRA dollars. Now, I want you to take a look at this image behind us. It's just the 2017 tax rates if you're a married couple filing jointly. Every dollar that you convert just becomes taxable income. So if you made $100,000 already for the year and you wanted to convert $50,000, it's kind of like you have $150,000 of earned income now for the year. As you can see, you were in a 25% bracket, so it just lets you know that you're going to be paying 25 cents on the dollar for every dollar you converted, which is about $12,500 of pure tax. So when we think about Roth conversions, first and foremost, that's what a Roth conversion is. You're just taking existing dollars, turning them into Roth dollars, and it's a tax liability when you do that, but then that money gets to grow and come out tax-free forever. Now, as a firm, Dave, we really have kind of 4 things that we tell people as far as why it would be a good idea for you or why it wouldn't be a good idea for you. What's our favorite old adage, Dave, is kind of what's the best way to eat it?
Best way to do a conversion, folks, at little bits at a time, or I don't want to get the animal people mad at me,
that's
but
a good point,
best
Dave.
way to eat an elephant, folks, is one bite at a time. Sorry for that old adage or old saying, but it's really true. Moving money over from this side where it's taxable, where you have that partner, and yes, getting it over to the other side where it's tax-free forever. Yes, there's a toll to pay that tax to get across that bridge. But once it's across that bridge, that's tax-free for your lifetime. And if you're married, you have a spouse, it's tax-free for his or her lifetime. And if you have children, they can inherit this money tax-free. Bradley, very few things in this world are tax-free. Roth is one of them, and we love Roth. We just have to be mindful of how we get money from tax-deferred to tax-free and the taxes we pay.
So those are the 4 rules. Number 1, do it in the right dollar amounts every year. Don't convert too much where you get yourself into higher and higher brackets. Build a plan over the following several years, or at least few years, where it's little by little each year. Number 2 is don't withhold taxes on the Roth conversion. Whatever that tax liability is, find outside retirement account dollars to pay for that, so all the money does end up in the Roth. Then number 3 is you want to make sure that that money is kind of long-term money now. It gets to grow for a while tax-free to make it worth it, which means step 4 is to pick the right growth-oriented investments once you do the Roth conversion. So you'll see those 4 rules that were up on the screen. Now you're armed, you're prepared, you know what a Roth conversion even is, and you understand the rules to know why it would be a good idea or how it would be a good idea. But in order to customize this for your own situation, go ahead and give us a call, come to our website. Dave, myself, and our team are happy to help build your Roth conversion strategy as well.
Well, we're going to teach you folks about a pension and how to create your own pension. Most of us, watching right now, don't have a pension. A paycheck for the rest of your life, how hugely important is that? And if you're married, how that paycheck can actually continue for your spouse as well. So what I'm going to teach you now is really what's important in retirement. And what's important is income, income, income. Paychecks have stopped. And now where do we get this income? And get as much income as we possibly can. So while you're working and making a paycheck, all you thought about was rate of return. Grow the money, add to it, and get the best rate of return that you could. But now what's king in retirement is withdrawal rate, yield. And so please refer up to this chart right behind me. And so let's say for an example, we had a $40,000 need, okay? We wanted to stack on top of our Social Security checks, okay? If we had that $40,000 need and we could get a 4% withdrawal rate, we would need $1 million, right? Well, getting that 4% withdrawal rate is kind of tough today. That interest rate world that we've been living in, you'd have to go back to the 1940s, folks, to find a period that's been this low. And so yield withdrawal rates today often might be more like 3%. So if you had the same need of $40,000, right, a year to stack on top of your Social Security, right? How much would you have had to save in order to get to that same $40,000 goal? Well, you can see it's $1,333,000. In other words, another 33% more money you would have had to save, okay, the difference of a 1% withdrawal rate. That shocks most people. When I say I could get you an extra 33% return, I usually make a lot of friends when I say that to people. Of course, I don't guarantee we can make 33%. Nobody can. But you get the point. It's shocking the difference of a 1% withdrawal rate can have on how much money you need to save to get to your income goal. I'd like to show you another chart. This is how you can create your own pension, okay? And in this example, if we could get not just a 3% withdrawal rate, not a 4% withdrawal rate, but a 5.5% withdrawal rate. Yes, and guaranteed. So if you were able to get a 5.5% withdrawal rate, and your same income goal was that $40,000, okay, you don't need $1 million, okay, you don't need $900,000, you don't even need $800,000, you need $727,000 at a 5.5% withdrawal rate, and that $40,000 is guaranteed for as long as you live. Okay. What's nice about that plan design, is that you don't give up control of your money. Like in the old days. In the old days were just about 7-8 years ago. In order to get this lifetime of income, you gave up control of your money. Not true today. So you put in that $727,000, that $40,000 is guaranteed for your life. And this is an example of a 65-year-old. But if you had $1 million, if you had $1 million in that first example, well, you didn't need to use all $1 million to get that 40% or $40,000 income goal. So you had this extra $270,000+ to invest. Well, what if you invested that $270,000, okay, into a dividend stock portfolio, one that pays a 4% dividend? Lots of great portfolios out there that do that. And if you had a little growth on the underlying stocks of 1%, well, that would equate to till age 95, 35 years of collecting this income, almost $1,200,000, right? So getting the most income in retirement is huge. And that more income, what does that equate to? Better quality of life, better standard of living. And that's what listening to Retire Right with Epstein White, that's what we're all about here, folks, is helping you maintain that standard of living and have it be huge for you. And certainly being tax efficient along the way is all that we do to help all of our clients. Thank you for watching.
You made it. Years of hard work, investing, planning, and now you're here. The long-awaited reward you spent a lifetime looking forward to. But what now? After years of growing a nest egg, now you want to manage it. Use it to fund your dreams. Make sure it lasts as long as you need it. And make sure it leaves a legacy for those you love. So what do? Wall Street continues to be uncertain, and many conservative options have all but dropped through the floor. How do you maintain opportunities for growth without risking what you can't afford to lose? That's where we come in. We are financial professionals. From investments and insurance products to tax reduction strategies, estate planning solutions, and guaranteed retirement income you cannot outlive. You've worked a lifetime to get here. Let us help you enjoy it to the fullest. For a special free guide entitled 10 Things to Know About Retirement Income, simply contact us today.
Well, hey, understanding your beta in retirement, well, beta is really the measure of volatility. And when the paychecks stop, folks, you really need to understand how much risk you're taking. And Bradley, most people out there don't understand this because most people don't have a plan. And how do you know the amount of risk or where the investments are going to go without this plan? And so we're going to spend a whole couple of segments, Bradley, on retirement income planning. But understanding one's risk in retirement is huge, Bradley. And no better person to talk about how to minimize risk in building retirement plans than my partner, Bradley White.
And I had a place I was going to take this, but I'm kind of switching gears here a little bit. So a little bit of curveball I'm throwing to you right now, Dave.
All right, brother.
There is a difference between risk management and risk tolerance management.
Oh, yeah. Most definitely.
They're not completely different from each other, but they're not the exact same thing. And I want to illustrate my point here a little bit. Bear with me on this analogy. It's not perfect, but I think it will drive the point home. Risk management tells us exactly how much money we could lose. And when it's all said and done, how much we could physically lose if the worst case scenario happens. Risk tolerance management is more of kind of how violent is that ride along the way. Now, if I were flying across the country right now, I could choose a first-class seat, right, in a nice 747, or I could choose, let's say, a fighter pilot, right? Okay, I could use a jet going 1,000 miles an hour here. My risk is technically the same either way, right? Plane crashes, I don't make it. That's the worst case scenario. The risk is the same. I would say the risk tolerance is drastically different.
Yeah, most definitely.
Right? One of them's a nice plushy ride the entire way. The other is obviously so violent that I can't handle that ride, which means even though that plane might get there quicker,
I'm going to want to hit the eject button,
I
Bradley.
really don't want to have any part of it, okay? So again, maybe not a perfect analogy, but the point being is if you are looking at your risk, that's hugely important in retirement. So Dave's point is the perfect place to start. Manage your risk. Make sure you can't lose more money than you can afford to lose in retirement. But really, this segment is also about understanding your risk tolerance, which is just making sure you don't let emotions cause you to make bad, logical investment decisions. When you look back at all these studies, and we have all these studies that we see, there's a great Fidelity Magellan story out there that you can look up. Peter Lynch, a name you might remember, had the best mutual fund, 20-something% per year in the decade of the 80s, Dave. The Magellan Fund was fantastic. And then Fidelity did a study later on and found out that more than half of people in that fund lost money. They took the best performing fund in the whole decade and found a way to lose money in it because when things are great and the market's high, I want to buy in. And oh my gosh, I'm seeing my accounts go down. This is bad. I want to get out. So it tells us that investments aren't necessarily the problem over the long term. It's usually us as human beings. And by the way, emotions are going to take over as we get into retirement because we have more dollars now. So we physically see the swings on paper have gotten a lot bigger. That's more emotional.
Yeah, no paychecks, Bradley. No paychecks coming in. And so, boy, you have to be careful there. Paychecks stop and losing money when that happens, not good.
So education usually is what keeps us from making emotional mistakes and doing logical mistakes. And most people just simply aren't educated on what kind of a portfolio they have and what their expectations should be. That's what this word beta means, okay? This word beta essentially means that how correlated to the market are you? Now, a beta of 1 means that the market goes up 10%, you should go up 10. And if the market goes down 10%, you should go down 10. So that's what a beta of 1 means. A beta of 2 would mean you're twice as aggressive as the market. So if it went up 10%, you'd go up 20, or vice versa. A beta of 0.5 would mean you're half. Now, I want you to take a look at this image of the screen, and you're going to see this is really our version of like a doctor's MRI, looking at all these mutual funds in your portfolios. And as you can see there at the top, we know how much cash you have or stocks you have, bonds you have, what kinds of different stocks and bonds you have. But I want you to look at this next image here. And this is where I don't want you to get caught up on a lot of these statistics. Okay, this is for us as portfolio managers, but we've highlighted that little beta and those numbers next to it. And you can see that if you had a beta of 0.52 as an example, now these clients understand, Dave, kind of for the first time ever what to expect. Right. Now they know if the market goes up 10%, they're going to go up about 5.2%. Or if the market goes down 10%, they'll go down about 5.2%. That allows them to first and foremost pick a portfolio they're comfortable with. Now they can assess their own swings, whether they want to be in that first class seat of the fighter, pilot jet. They can build that correctly, which is hugely important. But also, if the market goes down 10% and they only lose 2%, instead of being upset that they lost money, they're actually happy now.
Feel good about it.
Because they know that they should have lost 5.2%, and really all they did was lose 2%. So now they're not going to make that emotional mistake of just selling or changing things that were actually working quite well.
Right.
Or another way to say that is if they lost 8%, they're not going to go, oh, well, geez, the market lost 10, so that's why I lost 8. Yeah. Right? No, they're going to be upset because they should have only lost 5.2. And that actually tells them now that a change might be needed. But this time we know it's not an emotional or an irrational change. It's a logical one that the portfolio really wasn't working the way that it was designed to do. So what you've seen up on the screen here is really just a couple of images, but what we want you to do is go through this exercise, Dave. We want you to go ahead and send to us your portfolios, your IRAs, your 401ks. We will run this doctor's MRI. We will give you a portfolio analysis. We'll stress test all of those positions in there, maybe give you some recommendations on a way to improve what you're looking to do. So you'll see the number below here or the website. Give us a call, come on in, and we're happy to run this exercise for you.
Well, that's all the financial fun we have for you this week. We really appreciate you watching. Bradley shared with you a host of ideas and tips about mutual funds. And for that free giveaway, all you'd have to do is call and give us a ring, and we'll be happy to get that to you. So stay tuned to Retire Right with Epstein and White. We'll be here next week, same time, same place.